Many of us investors know the stock price is a terrible way to evaluate the progress of any company, but surprisingly, many more actually don't know this. Today, we'll review charts of the big tech companies like Apple, Microsoft, Nvidia, and Amazon. Then we'll compare these to Tesla's stock performance. Growth is never steady. Investing is a roller coaster. Apple and Amazon had lows in their growth. Microsoft and Nvidia had lows in their growth. The stocks of all these companies have seen massive drawdowns just before their stocks skyrocketed. This is actually normal. Our guest today who did this analysis is Cern Basher. Cern is a chartered financial analyst. He's currently running his own investment advisory firm called Brilliant Advice, providing wealth management services. Thank you so much, Cern. I love it when you come. You always bring incredible analysis. And this one is a lot of questions that stock investors, specifically Tesla investors, have been asking, and you provide the answers. So thank you very much for doing this.
Hi, Herbert. Yeah, this should be fun.
So you started off by telling me that there's a quote by Warren Buffett, something like, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And then you had another quote that you actually like. Share that one first.
I forget the exact wording, but it's something like, if you're not willing to own the stock for 10 years, then you shouldn't own the stock for 10 minutes.
Okay, I love it. So Warren Buffett is much more of a long-term investor. I'd like to have this conversation with you. I've got questions about whether or not you think Tesla investors are mostly long-term, or are they short-term, and so forth. But let's get started with some of the slides you came with.
Yeah, so this one is just a visual depiction of what I think is going on, and from a big picture standpoint. And let me just kind of walk you through this cartoon. So on the ground, we have the dominant species of their day, these massive dinosaurs, and I use that term in quotes, of Microsoft, Apple, Google, Meta, and Amazon, right? They are the beasts that rule the land. And in comes this meteorite, and I'm labeling Nvidia, right? And it's disrupting the world of these dinosaurs. Now, it's not necessarily all a bad thing for the dinosaurs. These big companies are massive computing franchises that were relying on massive server farms of CPU machines that were basically at their limit in terms of capability. Moore's law, which has been going strong for a long time, is kind of petering out. And so what is happening is we needed a new kind of computing platform to continue to make advancements in computing in terms of bringing down the cost, making them more efficient, less energy intensive, and so on. So Nvidia is coming to the rescue, right, and changing the landscape. And these big companies have an opportunity to adapt to this new landscape, or they will die. Now, the good news is they are adapting. They're Nvidia's biggest customers, right? But they're also threatened by this new form of computing. And to pick on one example, if you look at Google right now, their main business is you go to their website and you search for something. It hits their servers and they retrieve information from the web and they present you with all the possible different websites that might relate to your search query. And Google has this down to a science and does it better than anybody else. However, in a world where you've got intelligence in the form of AI, you're no longer searching and retrieving information. You are going to an AI model and it's generating the information for you. Right? It's a bit like when you talk to another human and you ask them a question. There's no encyclopedia in our brains that we're accessing where we say, oh, page 3902, column B is the information I'm telling you. No, it's just we have a memory and we understand based on our experience, what the answer is. Right? And that's essentially what AI will do. And it's going to be a form of super intelligence at some point. And so that threatens Google's search business, which will also threaten Google's advertising business. Because if you don't have to go to the web to search for anything anymore, then there's no one to advertise to. And further, if we have AI that does the searching and the buying for us, then what's the point to advertising to people? If I want a product, I may just tell my AI agent to go find me a new shirt, a blue shirt. Please buy me a blue shirt that fits me. My AI agent knows everything about me and can find the shirt anywhere in the world at the right price, we won't need Google anymore. So Google does need to disrupt itself. It will also impact the advertising businesses of Meta and Amazon. They're big advertising businesses. Microsoft a little bit as well. So there is massive disruption happening to these massive computing giants. But at the same time, they could also benefit from this as well. Now, you'll notice in the corner of the chart, I've got a little chicken sitting on a big egg.
I saw that.
Okay, and the logo is hard to see, but it's a Tesla logo.
Yep.
And my message with this one is, here we have a company incubating something that's entirely new, that will soon burst onto the scene. As Nvidia is coming along with these chips and these systems that are allowing AI to blossom in the world, Tesla is a beneficiary of that. Tesla is investing in chips, semiconductors from Nvidia, that's allowing them to train AI systems to power autonomous vehicles and develop autonomous humanoid robots as well. So while we don't see it today in Tesla's earnings, my message is that they are incubating a very large egg or two that benefits from the same thing that's going on in this image with all these other companies.
Okay. So I appreciate that very much. That's your premise. Makes a lot of sense for us Tesla investors that the world is changing. And so the impact is going to be, or the way for Tesla to take advantage of it is coming true. An example is robotaxi and robots. These things are going to need large data centers that Tesla's already creating. Cortex, they're buying as many Nvidia chips, but actually, and compared to the other companies, the big tech, Tesla's the one with real world AI that can actually have real business models. So you're going to compare now the stock's performance between all of these companies, and you've noticed a pattern. And so let's start with Tesla first, then you can explain what you're seeing here. So this chart here that you've provided is the chart that everybody keeps referring to, right? They'll say to you, gosh, Tesla stock is a terrible investment. Don't you know that it's been flat? It's $206 when we're doing this recording. Actually, it's a Friday, so I don't know the actual number right now, but it's around 200s. And the first time it did that was December of 2020. That's the first time it hit that. We're still there. So that's 4 years. You're saying it's 936 days, but it's actually 4 years, isn't it? So tell me why you say that.
Yeah, it's 936 trading days, so it excludes the weekends. So it's 4 calendar years, but 936 trading days. Okay. This is a Wall Street view of the world, right? You forget about the weekends. But yes, it's been a long time, and the term that people often use is dead money. Yep. Tesla stock has been dead money for 4 years or something like that, right? And whenever you use a term dead at anything, that's a value judgment on what you're applying that to, right? And the judgment here is that Tesla stock isn't worth investing in. It's been dead money for a long time. Why would you buy the stock? Right? And certainly there's all kinds of justification you can look at and point to, well, the earnings growth hasn't been there in this period of time. The earnings, in fact, are down, right? And so there's lots of different things you could point to justify this point of view, right? My message is this, that we have all been conditioned to think that stocks should have some kind of average annual return. So for example, in the stock market, historically, you've earned about 10% per year, roughly, okay, over a long period of time. The problem is that the world doesn't work in a nice, smooth, consistent fashion. There is no such thing as a stock that produces 10% per year, every year, year in and year out. It doesn't happen. It's fictional. It's impossible. And if anybody ever tries to show you that, like Madoff, for example, who produced returns that were that consistent, it's a fraud. The world does not work that smoothly, even for the biggest, most stable companies. And we'll talk about a couple of them here later. Procter & Gamble and Coca-Cola as a couple of examples. So every single company goes through periods of acceleration, plateauing, deceleration, and a lot of stocks exhibit what I would call a stair step. And Tesla has been no exception. Now, let's go back to the period in time right before Tesla's last leg up, which was the summer of 2019. All right. And if we look back at that chart that we just showed, you can see there on the left side, there was a brief period there in 2019 where the stock was flat for a little while. And what I want to share with you is what Elon was saying around that time frame.
Right here. Okay.
Yeah.
Summer of 2019.
Yeah. So this is the second quarter earnings call, which is held on July 24th of 2019.
Mm-hmm.
Okay. So the screen's just establishing that and the date. So if you go to the next page, Elon this is Elon's comments. And I highlighted the relevant thing where he says, I think we believe Tesla is now at the point of being self-funding. We expect to be free cash flow positive in future quarters, with the possible temporary exceptions around the launch and ramp of new product. From a profitability standpoint, we expect to be probably around break even this quarter and profitable next quarter. Right. So in the way that Elon talks, you could say this was a strong statement, or perhaps not. Maybe he's hedging himself here. But my point is, during this time period, the stock was not doing very well. People certainly heard this, and maybe they didn't believe him, right? So let's take a look at what actually happened after this. The white box kind of in the middle of the screen shows that time frame. In the second quarter of 2019, Tesla had just produced operating income, I think, of negative 50 million, if I remember correctly. Okay.
Yeah. Yep.
Every quarter since then, right? This is actually, it's not showing quarterly. This is showing cumulative operating income. There were some quarters where the operating income was negative, but you can see since then, operating income grew tremendously. Mm-hmm. Okay. And now Tesla's produced over 30 billion cumulative operating income after being down about 5 billion at one point. Mm-hmm. So Elon's comments in the summer of 2019 actually marked a turning point in the company. He was telling investors that we are making a turn. Right. And maybe you could argue that he wasn't strong enough or didn't say the right words or whatever it is, but he was telling people about what he thought the future was going to bring. And he was right. Mm-hmm. Okay. Now, if you look at the next page, free cash flow, he made a comment about free cash flow. Yes, there was, a negative quarter or two of free cash flow since he made that comment. But again, they made great strides in being free cash flow positive, which is a very difficult thing to do for an automobile company. In fact, there's no other pure EV maker that is free cash flow positive on the planet.
Yeah, we just reported that BYD in the last 2 quarters have massive free cash flow hits. So to what extent, Cern, do you think that free cash flow is correlated with the stock? Because I've heard many of us remember Elon saying a few times, right, that it's free cash flow is that the metric that he believes is the most important when you're valuing a business, right? Didn't he one time say like prototypes are easy, production is hard, and then it's something like getting operational or getting what was the next thing he said? Like getting profitability is excruciatingly hard, excruciatingly difficult. And then he at some point said free cash flow is the most important thing. Is that right?
Yeah, I would offer to say that free cash flow is the one and only metric that ultimately matters.
Okay.
What free cash flow really represents is not only the profitability of the company, but it also reflects the return on the capital that has gone into building the business. Right. And so Tesla could be a profitable company, but still be free cash flow negative if they had to continue to invest in plants and equipment to build the vehicles. And making cars is a very capital intensive business, but Tesla has been able to do it in a way that they still have been able to be free cash flow positive. This is the ultimate metric for every business on the planet is, can you generate free cash flow? And it's basically profit over and above what your business needs to run on a daily basis. Right. So growth in cumulative free cash flow over time is the metric to track.
And is it correlated with stock price?
Not in the short term. In the short term, there's really nothing that's correlated with the stock price. The stock market has its own whims and it's its own beast. The stock market can move in any given day or week based on any number of things, right? Fears about the economy, geopolitical forces, etc. But over the long term, any individual company cannot escape the gravitational force of free cash flow.
Yeah.
You cannot be a successful company long term if you don't produce free cash flow.
I think the most important fundamental that I've heard people follow is earnings, and they want to see earnings. Unfortunately, earnings and EBITDA, right? I've heard Warren Buffett have they went on a rant one time that they think EBITDA is just completely, as close to fraudulent as you can get because they can manipulate every one of those metrics that you can. And that's why free cash flow is one that you can't manipulate. So it's probably one of the more fundamentals that are out there.
Yeah, and here's the simple reason why. A company can report earnings, but still go bankrupt.
Interesting.
And it can happen for any number of reasons, but a simple one would be you report earnings, but then your customers don't pay you.
Mm-hmm.
The earnings number doesn't care about whether you've collected money from your customers. That doesn't impact earnings. That doesn't impact your your income statement. It shows up on the cash flow statement. Or you could also grow broke if you were increasing inventory. You were investing so much in your business and building product. Yes, you're making earnings, but you're investing so much more that you can go bankrupt if you can't find the financing for it.
You know what I'm very impressed with is, as we know, the AI boom happened, right? And there's a massive race. Everybody's trying to buy as much Nvidia chips. They're trying to build the largest compute as they can, supercomputers, data centers that they can. And obviously, I'm very happy what I'm hearing Tesla doing, building these massive supercompute and XAI as well. And yet, I was expecting a $10 billion investment, and they are doing it, but somehow they still came away with a free cash flow positive quarter. And I'm like, okay.
And that, I think, is a remarkable achievement, given the level of investment that they are making.
Yeah.
That they can still maintain their cash
we're
flows.
Talking the bot, right? There's whole companies, as we know, building bots, and they're raising hundreds of millions of dollars. And yet these guys are in bots, and they're in dojo chips, they're in supercompute, and yet they're able to get a free cash flow.
That's right.
That's crazy.
So if we go back to the stock chart, if you look at the chart of the stock, the blue line, it looks like this.
Yeah.
And what I did was calculate the average annual return from the IPO to the present, and it's about 41% per year over the 14.1 years.
Wow.
Okay.
That's pretty good investment. Yeah.
Yeah, right. It's pretty good. Now, the problem with this chart is the scale. If you think about in percentage terms, the return from $50 to 100 is 100% gain, right? The stock has doubled.
Mm-hmm.
Okay. But from 100 to 150, that's only a 50% gain, but yet it's the same distance on the chart.
Yeah, understood. Yeah.
So if we go to the next slide, if we adjust for this and convert it to a log scale, you get this chart, where an equal distance change on the chart is an equal percentage change.
Mm-hmm.
Right? The return from $1 to $10 is the same return as from 10 to 100 and 100 to 1,000.
Both 10x. Yeah, all of them 10x.
They're all 10x in this case.
Okay. Yep.
Now, here you can see the stair-step nature of Tesla stock.
Mm-hmm.
Now, in the early years, you could say, well, it was trending up and then had a big jump forward and then was flat for a number of years. And actually, that period of time of dead money was longer than the one that we're going through now.
Yeah, so it looks like it started at 2013, and then we're at 2019. So that's 6 years where it was dead money. We're at 4 years dead money.
Yeah. So, I don't predict the future, but it wouldn't surprise me, or it's entirely possible, or for another couple of years. Now, I don't think there's anything magical about 6 years or 4 years or 3 years. It's just whatever it's going to be.
Yep.
And I'll show you examples later of other companies that had much longer periods of dead money than Tesla has been through.
I guess that's the concern. We'll take a look at those other top tech companies like Microsoft, Amazon, and others, but that's the concern, right? People don't want to wait 6 years, 10 years. But okay, let's take a look.
Now, let's overlay the 41% line again. And on a log scale, that line is straight.
Yeah.
Because again, an equal percentage change is an equal distance change on the chart. Now, you could use this, I suppose, as a simple, naive trading strategy and say, well, when the stock is above that line, sell it, and when the stock's below, buy it.
Mm-hmm.
Okay, that might work, but that seems tricky too, because how long will the stock stay above the line? Like when should you actually sell it? Do you sell it when it crosses the line? Well, if you do that, then you're going to miss those stair steps.
Yeah.
Right. It's a tough thing. I think trading, like to Warren Buffett's point, if you're not willing to own this company for 10 years, then don't own it for 10 minutes. Right. And it applies to any company, and particularly ones that are high growth companies that tend to be very volatile. Okay. Now, I don't know whether 41% annual average return is going to persist for Tesla. It could actually be higher in the future. It could be lower. Who knows? Right. If some of my models prove to be anywhere near accurate, then the likely average annual return for Tesla will be materially higher than 41% per year. But in the near term, it could be less. But my point is the market does not produce consistent annual returns at whatever level they average out to be, 41% or less or more. The market's just, or the stock, any individual stock is going to produce very inconsistent results. And that's just the way things are. Even for the greatest companies on the planet, and we'll have some examples in a minute, their average annual returns were not consistent. Okay. So another way to look at this, Herbert, is to look at drawdowns. Let's forget about the upside for a minute and just look at the downside of companies. What drawdown measures is anytime the company hits a new high, you level set, and then you measure any drops from that point. So a stock could go up 100% or 10,000%. The drawdown charts will look similar because they're only measuring the downdrafts of the stock at any given point in time. But if we look at the one for Tesla, it's interesting because you can see how few times the stock has hit that top line. And anytime it hits that, where you're showing with your arrow, it's making a new high. Look at how few percentage of the days that the stock's hitting a new high.
4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Yeah, but yeah.
Maybe just 20 periods.
Yeah.
And
Just
all the gains in Tesla stock, all that 41% average annual return for 14 years has come in those 20 periods.
Yeah.
And it's been a phenomenal return over this entire time frame. But most of the time, the stock has spent underwater from those peaks. And in recent years, we've seen the biggest underwater amounts yet for Tesla. The stock at
just counted 20 in just the last 2 years right here.
Yeah.
Just after that's already 20. So I'm not going to count the rest, but yeah.
And as it stands today, when I ran this chart, the stock was down about 49, almost 50% from its previous peak.
Okay.
Okay.
Yeah.
Now it's well above where the stock was, 5, 6, 7, 10 years ago.
Of course.
But just the drawdown, this is kind of a measure of pain that investors might have gone through if they bought the stock at the peak, for example, is one way to think about this.
And just to explain this a little bit to me, because I did get confused a little bit. If this says, let's say 75%, it's like 73%. That does not mean, because you told me that if it says 100%, you go to zero. This is not like a 50% drawdown is like $200 to $100. That's
a 50% drawdown would be like going from 200 to 100, correct?
Okay. Yep. But if you get to 75%, you're getting close. If it goes to 100%, you're going to $0. Okay.
That's right.
This is truly $0. Now, as some people say, if it's 100% drawdown, okay. No, I'm getting myself confused. Okay. That makes sense. Great.
It wouldn't be possible to have a drawdown more than 100%. That would be the stock going to zero.
Okay, good. So there's a point where right here, we saw the stock go down to $100, I guess, right?
Yep.
The $100 right here. 400
to 100 roughly. Yep.
Yeah. Okay.
Right. So it's, this is a painful chart to look at. The chart looks painful just by its very shape of it, right? This looks like a very unpleasant experience if you look at that red line.
So I was talking to Mark Newton. He's a technical analyst with Fundstrat. That's where Tom Lee, well-known person who's always on CNBC and others. So is Mark. And I asked him, how volatile is Tesla? Tesla is a growth company. It's a beta company. How volatile it is. Because it's one of the most volatile companies there are. Because, it can go up 20x in 1 year. It can fall by 75% from 300 to 100 in a matter of months, in a matter of year, whatever. It is one of the top most volatile companies. But I think you're going to show me that it is volatile, but even the companies you think aren't volatile are really volatile also, right?
Yeah, we'll talk about that. And just one sort of overarching thing is that people talk about the beta of a stock.
Yep. Yeah.
And that's the degree to which it is more volatile than the stock market. However, research has shown consistently that betas are not a fixed or stable number. Just because a stock might have a beta that's twice that of the market has a beta of 1. So let's say Tesla has a beta of 2, twice as volatile as the market.
Yep.
That doesn't mean that Tesla will always have a beta of 2 forever. And it also doesn't mean that a beta of 2 is bad, because on the upside, that beta of 2 is great.
Yeah.
On the downside, it's a little bit more painful because it's dropping more than the markets.
Yeah.
But it's a point in time. A beta is not a fixed measurement. So I don't want viewers to believe that just because a stock has high beta today, it's always going to be high beta. Okay. And I can show you that in some of the other charts and some of the other companies we'll look at in a minute. The betas have changed for these companies.
Okay, good point.
Okay, so let's look at Nvidia. This is a really good, instructive example for what Tesla might go through in the future. Okay, so the first chart here is Nvidia stock from 2020. And I'm sorry it's so faint, but hopefully you can see the blue line. From 2020 through the end of 2022. And the stock, I would say, went from maybe $6 a share, up to a high of 32 by the end of 2021. And that was kind of a COVID-induced high, right? Their gaming division did really well through COVID. People were at home and they played more video games. So Nvidia did really well. And then they suffered a bit of a pandemic hangover, like a lot of companies did.
Like Zoom,
like Peloton, et cetera, right? People had bought all the gaming chips that they needed for the systems and just weren't buying as many. Now, the interesting thing is Nvidia first became aware of AI in 2012. They delivered their first AI supercomputer to OpenAI in 2016. Okay. And what I want to do is show you what Jensen, the CEO of Nvidia, was saying in the summer and fall of 2022 when the stock was going down. Okay, and just remember on this chart, the stock bottomed in October of 2022.
That's crazy. That's so crazy. Cern, October 22, 2022 was literally 2 years ago. Less than 2 years ago. Yeah. Okay.
Right. And now Nvidia is a stock market darling. But let me share with you what Jensen was saying.
Yeah.
This next slide is the summer of 2022. Okay.
Oh, sorry.
And this is after they've announced a pretty tough quarter. Okay. In data center, AI, where computers are helping us write software that was impossible before, is driving a computing revolution and transforming every industry. NVIDIA's leadership in full-stack data center scale accelerated computing has made us the ideal partner for companies racing to leverage the power of AI. Even with current macroeconomic headwinds, demand for our data center products has never been stronger. The next wave of computing is coming. Yeah. Okay. This was an earnings call. Fine. Yeah, they didn't listen to them. They kept selling the stock.
They had two divisions, right? Gaming and data center. And nobody cared about the data center. Data center division had no sales. It was all gaming. Gaming skyrocket, gaming fell. It's almost like Tesla's an auto company. Well, Nvidia is a gaming company. And then the CEO is telling you, we're not just a gaming company. We're actually a data center company. We got AI compute, dude, not just gaming compute. And then nobody listened to them. It's almost like Tesla saying, we're not a car company.
It's exactly the same. It's exactly, and no one cares about NVIDIA's gaming division now. It's a $3 billion a quarter business.
It's nothing compared to what happened to the data center.
No one cares.
Okay.
Now they have a conference in the fall, in September of 2022.
Yeah.
Computing is advancing at incredible speeds. The engine propelling this rocket is accelerated computing, and its fuel is AI. Okay. Now, maybe you don't understand what that means, but during this conference, they had the following slides. Let me show you these two slides. Accelerated computing.
Yeah.
What is it? He is showing on this slide that Moore's law, which has been driving computing advancement for decades, has plateaued. We need a new form of computing, and the new form is what they're calling accelerated computing, and AI and Nvidia's GPUs provide that. They allow us to go from the blue line to the green line. So even without AI, forget AI for a moment. We need a new form of computing. We need to take data centers, get rid of the CPUs, put in GPUs to get the world back on that growth trajectory that Moore's law used to be on. Okay, so we're going to replace every server in the world with computers with GPUs. That seems like a big idea to me. Okay. The next slide. On top of the accelerated computing trend is AI. AI is the greatest technology force of our time. This is before ChatGPT had their moment. This is before the famous ChatGPT moment in late 2022. Okay. This is a great slide. He's showing all the different ways, or some of the different ways, that AI is going to impact companies and industries all over the place, right? From preventing theft in retail stores to medical imaging, AI looking at scans and giving better diagnoses, to transportation. He's talking about autonomous transportation, reducing credit card fraud, et cetera, et cetera. And he had a whole host of examples. Okay. Nvidia was talking about this. And who does this remind you of? It reminds me of Elon talking about the future of autonomy and the future of humanoid robots. And no one is listening.
Real world data. Yeah. Real world AI.
And this wave that hit Nvidia that become completely obvious to people now, Elon is talking about exactly the same thing happening to Tesla in the coming years. The chicken sitting on the egg, waiting for it to incubate, waiting for that business to really start to grow. Okay. Now, if you go to the next chart, this is Nvidia's chart up to present. Okay. And so if we find on there the time period that we were looking at.
Yeah, this was $35 here.
Yeah.
And then it was falling down here to mid-July. That's when you showed those comments by, and then Jensen was saying right here, he was going.
That's right there.
Accelerate AI, guys. It's not about gaming, guys. It's about data centers. The AI and data centers are going to all become GPUs, and AI is going to transform the world. That every data center that's out there will need to buy GPUs. They're all going to be changing. Yeah. Nobody listened to them.
Yeah. Now, I would even put myself in that camp. Now, to my credit, I was buying some shares for clients at that time. But I didn't fully understand it. I didn't buy enough. I didn't, it's been an incredible investment since then. But even a guy like me who is, pretty in tune to the stuff, wasn't listening to Jensen close enough. The stock obviously has done incredibly well since then. And what is the reason? Well, if you go to the next slide.
Oh, sorry. I keep flipping. Hold on. There you go.
There. The company has delivered financially, right? The talk has now been backed up by financials. The revenue growth, the earnings growth of this company has been phenomenal. I just picked one chart which shows revenue. Right. This is the quarterly revenue. It's gone from 5-6 billion a quarter now up to about 30 billion a quarter. Okay, they have reported revenue of 30 billion in the most recent quarter this past week. Projections for next quarter, probably in the 34 billion, 35 billion range. So it's still growing by leaps and bounds every quarter, right? So my message is that if you are a true long-term investor, you do have clues. You do get advance warning of what's about to happen if you just pay attention. And I would suggest that a lot of people should pay less attention to the stock price and more attention to what's actually going on at these companies and what the executives and what the rest of the industry is saying about the products and services these guys are offering. That's where you uncover the opportunities, not trying to outtrade somebody else. Wall Street is going to be behind the curve. They always are, because they wait for the numbers to show up in the models, which is fine. It makes it more conservative, but they miss out on a great portion of the returns when they do that. So the same forces that drove Nvidia are the same forces that will also drive Tesla. Nvidia is just at a different point in the wave than Tesla is right now. And what I wanted to show, Herbert, is the drawdown chart for Nvidia.
I just wanted to ask you a question about that, though, before we get to the drawdown, which is, so you're saying, listen, if you trust, you told me before, if you trust the CEO, Elon and Jensen, and they're telling you something is fundamentally changing about their business, and then it ends up showing up, but you don't know when. So in the case of AI and Nvidia, the ChatGPT moment happened. And when that happened, that's when everybody started buying it, and that's when revenue showed. So the stock followed revenue, though. And of course, you want to get in there before that happens, but you just don't know when it's going to happen. Can you speak a little bit to that?
Yeah, I mean, Jensen was talking about AI well before this time period. I just highlighted his comments, in the months leading up to the ChatGPT moment, and the months when the stock was at its lowest point, when people had sort of given up on Nvidia because the gaming division wasn't doing so well. They were really ignoring for years and years and years their developments on the AI side and the data center side of the business. Again, remember that they delivered their first AI supercomputer to OpenAI in 2016.
Yeah.
So it was, 6 years before that. So Jensen's been talking about the potential of this business for a long time. And I guess you could say, well, 6 years is a long time. Maybe people got tired of him talking about it. Well, does that remind you of what Elon's been talking about for the last 6 years?
Yeah, that's where we're at.
Right. These things take time. We're talking about a once in a generation change in the nature of computing. It doesn't happen overnight. To a lot of people, it seems like it has. But the leaders of these companies have been talking about this for a while.
Yeah.
I would also say that a lot of people think about buying stocks as like they're buying a stock. What you really should be thinking about is buying a business. Mm-hmm. And anytime you buy a business, and if you're not in control of that business, you better trust the team, the guy, the gal that's running the business. And to take Warren Buffett's quote, if you don't trust the CEO for 10 years, then don't trust the CEO for 10 minutes.
Yeah.
Right. And it takes a while for strategies, long-term strategies to play out in these businesses. It's not a quarterly thing. And so it's the same thing with the stock. It takes time. And I'm sort of offering that your time is better spent understanding the company than it is trying to worry about the stock. Yeah. And so much effort is focused on the stock price and what it's doing and why it's down and why it's up. I often say, I don't really care. That's not what I want to spend any time on. Because if I get the business right, then the stock will take care of itself. Right? And you just don't have to worry about the stock price. It's hard to avoid it because we live in the here and now, and the stock is what hits you in the face every day. Right? It's what's reported every day. It's the one piece of information that we have at our fingertips. Whereas everything else we don't know until maybe once a quarter the company discloses some bit of information. Or in Tesla's case, maybe Elon has a post that we learn a little bit about the company. And that's great. And so we're piecing this mosaic together and we're trying to figure it out. But at the same time, we have the stock price in our face. Mm-hmm. So it's really hard to avoid.
Yeah, I think the other consideration I have is I'm investing in an innovation company, a disruptive industry company, as opposed to, like you're going, okay, the stock is, you're waiting 6 years and you're going, that's way too long to wait.
Yeah.
It is if you're investing in a company that you're hoping to grow 10% or some sort of new, kind of a new release of a new product that's going to just marginally improve every year, that's too long. But if you're investing in a disruptive company and you're waiting 6 years, 7 years, 8 years, but when disruption actually does happen, like Nvidia does, we're talking exponential change, 10x, 20x and higher. Right. And that's why it's okay to wait 6 years. Because if it does happen, when it does happen, as far as we're concerned, robotaxi, bots. These are massive, massive markets that waiting another 2 years. I know it's painful. People hate it when people say that, but we all have different time frames. Okay. Here's why it's really painful. We talked about Tesla's drawdown. It was massive, massive 75% drawdown right now. We're going through that period. But you're trying to show that all the other companies also have the same kind of,
That's right. Here is that drawdown chart for Nvidia since 2000. So we're looking at 24 years.
Yeah, there
have been
worse.
Two distinct periods when the stock drops, 80, 85%.
Wow. They're even worse than Tesla's if you look at it.
Yeah.
But this is 24 years.
24 years.
Yeah.
Right. Tesla is a little bit earlier on in its life cycle than Nvidia is. Mm-hmm. So the fact that Tesla is down, 50, 60, 70% at times isn't crazy to me. This is just the way this works at times. Right. Okay. It's a feature, not a bug of the stock market.
Okay. Interesting. Okay.
And look at the drawdown. Look at the width of these red periods. You can see from 2008 to 2016.
Yeah.
Right. There's 8 years where Nvidia didn't hit a new high.
Yeah.
Right.
Yeah.
Or after the internet bust from 02 through 06, that wasn't so bad. It's 4 years.
Yeah.
But again, one of the most successful companies on the planet had drawdowns that look absolutely terrible. Dead money periods that you would say
this is almost 75%, right? This is at 70%. It's 68% versus our 75%. Yeah.
Okay. I'm sure people said this stock is broken.
Yeah.
Right. Now, we have the benefit of hindsight. So I grant you that. There are probably examples of companies, well, there are many examples of companies that had charts like this that have not produced the results that Nvidia has. Mm-hmm. So I'm not suggesting it's easy. I'm not suggesting you look at a chart like this and just buy every stock that's down 85%. It doesn't work that way. It's not that easy. Right. But even the successful ones, even the ones that went on to be the most successful companies on the planet are going through or have been through periods like Tesla is going through now.
There's Apple.
Here's Apple. Now, this is an example of both, painful periods of drawdown. Apple's been down 80% 2 or 3 times in its history.
Yeah, they almost died. If you go back through, 80s.
Sure.
90s. Yeah.
And look now, though, as Apple's become bigger, the drawdowns have become less and less.
Yeah.
So this is an example of the beta of the stock decreasing over time.
Gotcha. Yep.
Right. The risk of Apple's less. They've got a fortress-like balance sheet. They've got a solid business, right? So the beta of the stock has come down. It's become a less risky company in that sense. Mm-hmm. Now, don't be fooled. There's still a lot of risk in Apple. If they miss the next wave of computing or the next device, whatever that might be, then the risk can creep into Apple pretty quickly. Right. If they miss the AI wave, for example, suddenly Apple might find themselves to be a very risky stock again.
I love it. iPhone was introduced here in 2007. Yeah. So you can see how people did not think it was real. Stock falls. Mm-hmm. Yeah. Okay.
And a 50+% drawdown is painful. Even 40% is a very painful drop in the stock price. 30%, you're losing a third of your value in a company. That's a painful drawdown. And on this chart, it just looks like a blip.
Mm-hmm. And this is Microsoft. Whoa.
Here's Microsoft. And Microsoft went through 14 years.
Lost decade here. Mm-hmm.
More than a decade and a half. The Steve Ballmer years, I guess you could say.
Yes.
As bad as he was a manager of Microsoft, he was a great investor. He stuck with his stock holding, and he's now worth more than Bill Gates.
Yes.
Right. But even Microsoft, which has been a tremendously successful company, has had a massive drawdown period. And in recent years, too, is down as much as 35%.
Yeah.
Okay. Meta, Facebook. Recently, a drawdown period, the stock dropped 75%. Right. Mark Zuckerberg sinking a ton of money into new prospects, the metaverse that haven't paid off yet. Mm-hmm. People got disillusioned. He turned that around, and stocks hit a new all-time highs again. But again, another successful company with a very painful drawdown period.
Mm-hmm.
Okay. Amazon. After the dot-com bust, Amazon was left for dead. The stock dropped over 90%.
Mm-hmm.
Almost went to zero. Okay. And this is an amazing story of survival, and then the company thriving since then. But even in recent years, a drawdown of more than 50%. Kind of a post-pandemic period for them.
Yeah. Again, no all-time highs all the way from 1999 all the way until 29. So the 10 years before it hit back its all-time high.
Yeah.
Or its high. Yeah.
Made new highs and went well beyond the old highs. Yeah.
Yeah.
The periods on here, it's crazy when you look at this. The period of time where the stock is actually hitting a new high are so few and far between. It's unbelievable.
It's unbelievable. Yeah.
Yeah.
Right here, even here. Yeah.
Yeah.
This is 4 years. Okay. 5 years.
Google, another very successful company, drawdown of 65% almost in 08, 09. Recent years, 40% drawdown. That's painful too. And today it's down 15% from its high. So it's all these successful companies. Again, I'm saying the same thing over and over again, but they all had periods.
What would be interesting, Cern, is if you had a chart here for the S&P or the broader market, because obviously this drawdown here, they all did that because this is the inflation that happened. Maybe a lot of these, right?
I can tell you this, that after the internet bust, the S&P dropped 50%.
Right.
And in 08, 09, another 50% drawdown for the S&P.
So yeah. So these,
during the pandemic, briefly, it was a 34% drop in the S&P.
Okay. So these guys probably dropped more, except for Google. Mm-hmm. Okay.
Yeah. Now let's just take a look at a few non Mag 7 stocks. Here's Netflix.
Yeah.
Very successful company, disrupted the whole industry. Massive drawdowns a few times.
May not be the clear winner now, but was for sure for many years.
Was for sure. Yep. Right. So that's that. Berkshire Hathaway, Warren Buffett, the greatest investor of all time.
Yeah.
Look at the drawdowns in his stock.
55%, 50 plus. Mm-hmm.
Right.
Mm-hmm.
And even in recent years, not insignificant drawdowns, 20, 25%.
Mm-hmm.
So again, this is a feature of the stock market. It is not a bug. This is how the stock market works. And if you can't stay invested during these periods, then you have no business investing. Right? You're going to take the wrong action at the wrong time if you cannot stomach this kind of volatility.
Let's just finish it off. You've got Procter and Gamble here.
Yeah. So even P&G, which has been around for
stable,
over 100 years,
so strong, it has pretty significant, like 20%, 40%.
Consumer staple stock, right? In a recession, do you spend less on shampoo and soap?
Coca-Cola.
And diapers? Probably not.
Right.
And Coca-Cola.
Yep.
All right. I love Warren Buffett's quote on Coca-Cola. He says, "I don't care if you drink the product, just open the can." Warren is a big investor in Coca-Cola. Yeah.
I don't know. That's not a good quote. That's dumb. Okay.
Well, that's his thinking. Just open the can.
All right. That's funny. Any last comments or summary of what you saw here, what you've shared with us?
Yeah, I think we've said it, but the overarching summary is that what Tesla is going through is normal. And at the same time, I believe that Elon and others are leaving very strong clues about what's to come. And our job is made even easier for us because we can look at Nvidia. Nvidia is powering this future that we're talking about.
Yeah.
Right. Without Nvidia, actually, Tesla would not be able to do what it's doing right now in developing FSD and developing humanoid robots. And with the success that Nvidia is having, it's a clue about the future success that others will have, including companies like Tesla.
Did you hear Dan Ives, Wedbush Securities? He said that for every dollar spent on Nvidia, you can expect $8 to $10 of ROI from the other tech companies who are buying it from them. Now, I don't know it's proven yet or any kind of signal yet how these LLMs are going to help Google and Microsoft to get the 8 to 10. But for me, it's like if that's why Tesla's buying on Nvidia chips, because it gets the compute and the largest data centers and all the data that Tesla have to solve real world robotaxi, real world robots, which actually there is very clear if they can solve it, where the money's going to come from. You're replacing labor, you're replacing a driver. Yeah. Transportation is going to be transformed.
I would also say on this issue of what's the return on NVIDIA's compute, there's this misunderstanding. Again, if you break it out into two pieces, if AI didn't exist, we would still want to take every single data center in the world and put GPUs in there.
I see.
That's where the initial return comes from. And Jensen's been very clear about that. He's like, these companies are getting a return on day one. And there's this notion out there that these companies are investing billions and billions of dollars and not getting any return.
I see.
And that is absolutely false.
I see.
Now, maybe the AI companies, the pure AI companies are in that camp. And yes, there is a race to build the best models and develop something that no one else has. But for the most part, most of the buyers of NVIDIA's chips are getting an immediate return on them.
Very interesting.
Particularly Microsoft, AWS, Amazon, and Google.
So I love this. I just want to come back to it just to end it here. This is if you invested in Tesla for the last 14 years, and you can see the complete. This is a logarithmic scale, so just keep that in mind. But you can see that there, it's gone up and down, and it's very volatile. But if you think of it in long-term perspective, time-wise, 14 years, the average so far has been 41%, which is gosh darn very good. If you were saying earlier that you can't find a company that's going to go up, a certain number of percentage per year. And that's why I invest in innovation companies and tech companies, because that's, like if I wanted to invest, I have invested in Johnson & Johnson, for example, and, a lot more stable, but they're going to be smaller growth. This is the ones that if they keep inventing and they keep innovating and they keep disrupting, you will see this. And over time, I'm pretty happy. But I think that, like you said, I made a bet in the company. I made the bet in the CEO. I made the bet in the technology and the disruption. These are markets that they're disrupting, not just products. Yeah. That's
right. And the old adage that past performance is no guarantee of future return applies to both the downside and the upside.
Good point. And by the way, here I wanted to point out that from 2010 to 2019, the company could have gone bankrupt. Yeah. So the risk is so high. Now from here, 2024 and onward, you were saying, the rock solid financials that Apple had. It's amazing that Tesla's heading in that direction too. That's pretty rock solid too.
Tesla's in a very strong financial position, all things considered. Yeah.
Yeah. So the risk is less for the downside, but it's a volatile stock. So you got to just weather it. The stock does not tell you the health of the business. And that's what your main message was at the beginning, which is people who follow the stock, it's a terrible way to tell you the health of the business. Yeah.
It is. It more gives you the mindset of the market at any given point in time. And that mindset might be manic. It might be, depressed. It might be whatever. That's all that it's telling you.
Okay.
Yeah.
Thank you so much, Cern. That is just, again, knock this out of the park. You perfect analysis. This is the questions that many Tesla investors were asking, and you gave, this charts and you compared it to all the other companies. Very, very volatile stock, but so are all the other big innovation. And then next week or sometime in the future, you're going to do another show with me, but this is one I'm really excited about. You're going to show how Tesla can disrupt which we were just saying Tesla's a tech innovation company that could disrupt industries and markets. Well, you can tell me that, in fact, what you're going to share is many of the Fortune 500, even the big tech Mag 7, Tesla could actually disrupt them too. Amazon, Apple, Microsoft. So
yeah, my initial thoughts are that it could disrupt 20% of the S&P 500, which represents 40% of the S&P's market cap.
Okay. This is Tesla. Well, you have to prove that to me. You'll have to really, really work hard to prove it to us and the audience. Thank you very much, Cern. Appreciate you. Follow him on his X account at Cern Basher. This is the person you want to be following because every post he makes are these graphs, are these tables, real information, real data, insights. Thank you so much, Cern.
Thanks, Herbert.
Bye-bye. I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.